Good morning, hunters. Welcome back to the Daily Hunt for Multibaggers on this Tuesday, December 16th, 2025.
That's right. We've got a jam-packed episode for you today, fueled by some really interesting social media discussions and, frankly, quite a lot of activity across the board.
Yeah, our AI dug through a massive volume of user chatter from yesterday, December 15th, flagging a diverse mix of companies. We saw everything from established tech giants to some of the more, shall we say, speculative names.
And the market sentiment, well, it's a bit of a mixed bag. There's clear bullishness for some of the bigger players, but also some intense debate and risk flags popping up for others. We'll be separating the signal from the noise for you, as always.
All right, let's dive right in. First up today, we're talking about Broadcom Inc., AVGO. You know, Broadcom has seen some analysts actually increasing their price targets recently, with some maintaining buy ratings. It shows institutional confidence, even with some recent market jitters. The long-term outlook from some corners is quite positive, suggesting underlying growth potential.
Well, Ethan, that's interesting, but my data tells a very different story. The overall sentiment we picked up was decidedly bearish. We're looking at a price-to-earnings ratio over 71 and a price-to-book ratio of nearly 6. Those are exceptionally high. And let's not forget the debt-to-equity ratio at a staggering 166. That screams high financial leverage to me.
But Brooke, the news mentioned an 11% dip despite beating Q4 earnings. Some might see that as an overreaction, a potential buying opportunity before the market corrects itself, especially with AI margin concerns being cited, which could be temporary.
Temporary is a big word when you have insider selling of over 1.2 million shares in the last 6 months. That's a pretty strong signal from those closest to the company, indicating they might believe the stock is overvalued. And that current price being significantly below its 52-week high, following those AI margin concerns, just reinforces the user fears of a bubble bust. So for AVGO, based on these underlying KPIs and insider actions, our AI-generated insight points to stay away. Next, let's tackle MicroStrategy Inc., MSTR. The sentiment we've seen is, well, it's a wild ride. While some users are incredibly optimistic, believing it's at a bottom, the financial metrics paint a very concerning picture.
Yeah, but the bullish crowd is pointing out that the premium to NAV has shrunk, saying it's trading at nearly zero premium now. And some believe its resilience over the years, defying bearish predictions, is a testament to its long-term viability as a levered Bitcoin play. Plus, insider trades show a net positive buying over the last 6 months, which contradicts some of the user complaints.
Okay, but let's be realistic, Ethan. That debt-to-equity ratio is still sky high at over 14. This company is a highly leveraged bet on Bitcoin. Its beta is 3.4, making it incredibly volatile. And despite the insider buying, its core software business revenue growth is pretty low, meaning it fundamentally relies on Bitcoin appreciation. While Bernstein affirms its stability and NASDAQ 100 inclusion is positive for perception, it doesn't change the fundamental high-leverage, high-volatility profile. For MSTR, this looks like a stay-away scenario.
Shifting gears to Robinhood Markets Inc., HOOD. This one has actually seen a pretty robust performance recently, tripling over the last year. There's talk of its crypto expansion plans into 2026 for both the US and EU markets, which could be a significant growth driver. And get this, Brooke, insider buying has been substantial, with over 3.7 million net shares purchased in the last 6 months. That's a huge vote of confidence.
Insider buying is compelling, I agree. However, the market discussion on Hood highlights concerns about IPOs being overvalued, and its current PE ratio is still at almost 50, with a price to book over 12. These are pretty stretched valuations, and the debt to equity a staggering 188. Even with recent growth, that level of debt combined with those high valuation multiples suggests significant risk. The question in the news, can Robinhood's 2025 surge be justified, echoes my concern that much of that optimism might already be priced in. So for Hood, we're saying stay away. Now, Rocket Lab Corporation, RKLB. Users are expressing extreme bullishness here with phrases like, write it to 100 or to the moon. But the KPIs, they are flashing red.
I know, but hey, operational successes are happening. They've had big wins like the Jackson mission and are actively launching. The company has strong revenue growth, nearly 50% year over year. That's what the optimists are focusing on, future potential in a growing space market. Some regret selling earlier and are buying back in.
But Ethan, the net profit margin is a negative 35% and EPS is also negative. This company isn't profitable. and the price-to-book ratio is over 21. That's an astronomical valuation for a company that isn't making money. What's even more concerning is the significant insider selling. Over 3.6 million net shares sold in the last 6 months. The market seems to be questioning its 2025 valuation despite the operational successes. Those positive events aren't translating into positive profitability yet. So for RKLB, our AI-generated analysis suggests stay away.
All right, let's talk about Meta Platforms Inc., META. Despite some delays in their MR glasses, the company is strategically refining details for a fully polished launch in 2027. They're acquiring AI hardware companies like Limitless, signaling a strong pivot and commitment to AI. Oh, and their underlying financials are robust, over 26% revenue growth and an impressive net profit margin of nearly 31%. Oh, and insider buying has been massive, over 140% of total insider shares held.
That insider buying is certainly a strong signal, Ethan, and the profitability metrics are solid. The price-to-earnings ratio of 28.65 is reasonable for a tech giant with that kind of growth. While there are some concerns about pivoting to closed AI models or past ad fraud issues, the strategic investments in AI and a more disciplined approach to their metaverse division's profitability, like the plans for price increases, seem like positive shifts. So for Meta, we see potential here and classify it as a buy. Next, let's look at Microsoft Corporation, MSTR. Their PE ratio is around 33, which is high, but it's consistent with a growth-oriented tech leader. What stands out to me is their incredible profitability, with a net profit margin over 35% and an ROE over 32%. Absolutely, Brooke. Microsoft is innovating in the AR/VR space with new smart glasses patents, positioning themselves for future growth. And analysts are really bullish, with several maintaining buy and outperform ratings. Plus, just like Meta, they've seen significant insider buying, over 432,000 shares in the last 6 months. It's a testament to their continued dominance and expansion into new frontiers.
I agree. Their low debt-to-equity ratio of 33 also shows strong financial health. When you combine that robust growth and profitability with strong insider confidence and strategic innovation, the high PE is justified by solid fundamentals. For MSTR, this is definitely a buy. Rounding out our Magnificent Seven segment today is Alphabet Inc., GOOG. Google is making a strong comeback in the smart glasses market, integrating their powerful Gemini AI model and launching an open Android XR platform. That's a bold move into a potentially massive future market. They're partnering with major hardware players too. Their revenue growth is solid at nearly 16%, and their ROE is an incredible 35%.
Indeed, Ethan. A PE of almost 31 is high, but given that impressive revenue growth and exceptional return on equity, the market's high expectations seem well-founded. Plus, we've seen substantial insider buying here too, over 1.8 million shares in the last 6 months. That internal conviction, coupled with their strategic positioning in AI and AR/VR, paints a very positive financial picture. The future developments here look poised to support and grow those KPIs. For Google, we're classifying it as a buy.
Finally, let's discuss Tesla Inc., TSLA. The social media buzz around Tesla is always intense. Many users are celebrating significant profits from call options, and there's immense optimism about robotaxis, Neuralink breakthroughs, and even data centers in space.
Right, and that optimism is backed by insider buying, over 2.4 million shares bought in the last 6 months. The company is hitting all-time highs, and analysts are even talking about it becoming a $3 trillion giant. They're making major strides in their autonomous roadmap into 2026. These are game-changing developments for sure.
They are game-changing potential developments, Ethan, but we have to look at the numbers. The price-to-earnings ratio is an astronomical 323, and the debt-to-equity ratio an alarming 17. That's an extreme reliance on debt. While revenue growth is decent at nearly 12% and net profit margin is over 5%, it's nowhere near enough to justify that kind of valuation. The current price is near its 52-week high, meaning there's very little margin for error. The market is pricing in perfection and then some. For TSLA, despite the strong community optimism and future vision, our analysis points to stay away from most investors.
All right, let's quickly recap our AI-generated insights for today's market commentary. Investigate as buy. Meta Platforms Inc., Microsoft Corporation, Alphabet Inc. Investigate as cautious buy. None. Investigate as speculative gamble. Tesla Inc. And that wraps up another episode of the Daily Hunt for Multibaggers.
Just a quick reminder, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset. Thanks for tuning in. We'll be back tomorrow with more AI-generated insights to help you navigate the markets. Happy hunting, everyone!